So today I'm going to talk a little bit about keepers. These are essentially utility layer workers that maintain blockchain networks. We're pretty fortunate at Polychain to work with a number of leading technologists and technical teams in the space. And in working with such a large number of projects, there are a certain amount of trends and commonalities that we see emerging among some of the top projects across the ecosystem. And this is sort of one of a couple of observations that we're able to make and we'll continue to share with the entire industry. So just quickly, Polychain Capital, we're a diversified portfolio of blockchain-based digital assets. A couple quick important disclosures. This isn't investment advice. It's not management consulting advice. It's not a solicitation or anything else. So lawyers required that one. But into the nitty-gritty. So when tokens are designed correctly and help accelerate network effects on a blockchain-enabled network, not only can they help drive network effects, but they act like rocket fuel for network effects. And we've seen this before. This is a graph of Bitcoin's hash rate, which is now somewhere in the 200 or 300 times the entire computational power of Google. Arguments regarding the marginal utility of Bitcoin's hash rate aside, what we observe here is an absolutely incredible network effect that has taken hold and driven just an extraordinary amount of resources towards securing a blockchain. And however, Bitcoin was only really designed to have its transaction ledger secured. And what we're starting to see are different networks where this work being performed by these self-interested actors, which I call keepers, can drive many other different behaviors and far more useful resources towards a network. And so these keepers typically maintain stability of a network. A very important point is they dramatically lower the cost to users. So if we separate a network out between its transactional user layer and that network utility layer, if you can remunerate the network utility layer to provide some interesting service or resource like validation or computation or storage, you can dramatically lower the cost to the user layer of the network. So again, using the Bitcoin example, originally, transaction costs were supposed to be nearly free. That did not end up being the case, but that was due to human intervention. But again, what we'll see on many of these networks is the cost to the general, what I call retail user, ends up being nearly free. And long-term sophisticated interested network players, which are these utility players, they dedicate significant resources, typically they're professional over time. They're probably the best position to be remunerated in a highly volatile native token rather than forcing the user layer to sort of transact in this token. And I would also argue that one way or another, your keeper layer in your network is going to have a very significant voice in the governance of that network. And I think we can see this in basically any network any blockchain-enabled network that exists today. The miners or that utility layer often has a very significant voting block and their voice is heard loud and clear. So this is a little bit difficult to see, but we can kind of go through many examples where we're seeing this. So Maker, you've got arbitrage seekers called keepers. This is one that I contributed directly in the white paper. We see it with TrueBit, who's here, where they've got solvers and challengers. We see it with Raiden and the operators. Filecoin with Filecoin miners. These miners provide storage. Cosmos, which is another fantastic project that we're very happy to support, where they have validators as well. And so in each case, you have, outside of the standard transactional use case of the network, a layer of professionals underneath that who are providing a critical service to that network. And basically, they're often, again, best positioned to be remunerated in the native token. They provide some stabilizing force of the network. They allow the network to be used by users for nearly free or extremely low cost. And one way or another, they have governance, some kind of governance control over the network. Some observations on governance. Now, while keepers, because they're professional, typically thoughtful, sophisticated players, they're very well positioned to either directly or indirectly take place or take a place in governance. What we know today is that governance on-chain is very, very difficult. And what we often find recommending to our projects is that they grandfather governance in over time. And a perfect example of this is Maker. So Maker uses what's called simulated governance, where all the major MKR holders are heard in governance meetings. Final decisions currently rest to the core dev team, but this will change over time, and they will eventually relinquish control of the network to that keeper function and to the keepers of the network who own the MKR. In other instances, what we're starting to see and what we're going to see probably in the next 6 to 12 months are fully on-chain implementations of live governance. So Tezos and subsequently Dfinity will be early examples of that. Now, these are projects that are kind of throwing the kite in the air and hoping that governance flies. Fortunately, they've done a lot of research on governance and are thinking about it very thoughtfully. There's a lot of checks and balances in place. But I think across the space, one of the observations that we make is governance is extremely difficult. Obviously the DAO was an early attempt at governance that didn't work out too well. And governance needs to be approached with extreme caution. However, it's an important element of a thriving blockchain over time. The big problems that we see most notably in Bitcoin, but I think we're starting to see remnants of it in Ethereum as well, is around governance and not having a clear governance function for moving the protocol forward. The remuneration layer. So as I mentioned, keepers are naturally best positioned to be paid in the native token. You don't really want, or I don't like to see where users have to use the token to pay for their services all the time, and they're kind of the driving force behind network utility. That's because if the users are forced to use the token all the time, then the speculative sort of drive behind a lot of token holders will lead towards less transaction throughput on that network. And you don't want that. You want the network to be used as much as possible by retail users all over the world. And so if they have to make the choice between using the network and speculating in the token, then you're going to inevitably have less use of that network. You don't want that. You want to drive and accelerate network effects on your network. So this is why we think that it's naturally more efficient to drive the token and the remuneration strategy, whether it be a block reward or something else, towards that keeper layer. However, there's a caveat here. Keepers can't be the only group that sort of have demand for the native token. Otherwise, if you add governance to it, then you're going to have a network that is totally dominated by those keepers. The keepers could have a myopic view of the way that the network should develop, and that actually may not be in the best interest of the network or the users over time. And so we like to see when there are different layers of keepers on a network. So Polkadot's a good example of this, that has fishermen and has validators and has nominators. We also see this in TrueBit, where there are challengers and solvers, and having a Nash equilibrium between different network actors, different professional network actors, that sort of keep stability in the network is sort of an interesting solution that we're quite positive about. Thinking about kind of categories of keepers and where we are in the ecosystem, I've sort of thought of 3 at this point, but I'm really open to different suggestions of how we kind of create a taxonomy of these network actors. Gatekeepers of trust. These are often like validators in a network, So the validators of Cosmos is sort of a perfect example. And there's lots of these up there, especially as we move into parachains and the need for staked validators. Arbitrage keepers is sort of an interesting, somewhat esoteric one. So in makers, the keepers are basically like arbitrage seekers. So they're traders that will kind of seek arbitrage moments and in their own self-interest maintain the network stable, maintain the DAI stable currency stable. We see this with Fisherman and Polkadot. And this is a group that sort of scans the network looking for these opportunities, and in their self-interest, maintain the interests of the network as a whole. And then finally, resource transactional keepers. So this is like Filecoin on IPFS, where they trade some specific resource, in this case storage, for the native token. And this is really interesting because when there's this dedication of a certain amount of resources to the network and you've got a block reward, the block reward often is enough of an incentive for those keepers that they don't need transaction fees. So it's not that storing files on Filecoin will be a little bit cheaper than Dropbox or Amazon. For you, the retail utility user, or the retail user, because the utility layer is adequately incentivized by the block reward, storage on IPFS Filecoin will be basically free. And that's a really compelling value proposition when you start to talk about resources, whether it be computation or file storage or others. So a couple further just sort of implications and some ponderings that I've had with respect to this theory. Obviously, again, checks and balances are required. And so you have to have equilibrium between that user layer and the utility layer of sort of desire of the token, and whether it be you have different layers of utility or whether you have some other incentive that drives demand for the token. That's an important part of a sound crypto economic model. I would argue, and this kind of somewhat controversial, especially internally, but I would argue that governance is valuable in and of itself. So if you had a network and the token just served a governance function, that's actually still valuable, as long as it can't be forked out. But governance in and of itself is very difficult, but extremely valuable. And then thirdly, and maybe most importantly for a lot of people in this room or in this ecosystem, all of these networks, Cosmos and Maker and Truebit and Definity and all these, and Tezos and all these guys will spawn their own ecosystems, which represent enormous, enormous opportunity for very sophisticated and capital pools with deep technical skills. You have to have those two. But what it means is that entrepreneurs should be scaling bigger, faster. Again, we saw this with Bitcoin. We saw this with Ethereum. We went from mom and pop shop miners to very professional, sophisticated miners extremely quickly. And I think in this kind of second iteration of more complex networks, we're going to see it happen even faster and even bigger. And so I'm just incredibly grateful to work with a lot of these leading technologists on the future of Web3. And really excited to see kind of what new keeper layers pop up and what kind of new networks we can create using crypto economics and accelerating network effects. So fortunately, we're starting to kind of see some traction on this. So different projects, Raiden, Maker, a bunch of different projects are starting to use this concept specifically as keepers. If you want to reach out, we are hiring, and a lot of the projects that I've just mentioned are also hiring. Focus again mostly on technical skills and people willing to get in the weeds in this technology. But please reach out whether you have any questions, comments, critiques, or whether you're just interested in getting involved in these networks. Thanks.
Any questions? Thanks. I just want to ask, well, first off, Matthew DeSilva from ETH News here. Quick question. You talked about the value of governance, and you kind of said that there's this inherent value to it. I'm trying to understand, could you speak a little bit more about that inherent value? And also the way that you speak about tokens, it seems like you regard them as securities. Am I incorrect in that assessment?
No. So whether a token is a security or not is a totally separate matter, and we could have an entire conference. In fact, there are just on that matter. But in this case, a token that is remunerating a keeper layer, we've established pretty soundly is clearly not a security and will not likely be classified as a security by the SEC. So it's just purely a hypothesis of mine that governance is an important enough function to have value in and of itself. So if the token did nothing else besides governance, and this actually stems mostly from just Silicon Valley investing, where a lot of startups, the vast majority of startups, don't make any money yet. And so what do you have in exchange for, say, ownership of part of that network or part of that company? You typically have governance, but people still value it, even though the DCF of that startup isn't making any money. So given the fact that Silicon Valley investors value essentially cash flow zero entities just because of the governance and a potential far out in the future opportunity to potentially profit, I would say that should probably apply to these open source networks as well. Again, just a bit of a hypothesis there. It's not a tremendously strong opinion at this point. We'll have to see how that works out.
Okay, thank you.
Anyone else?
Alrighty, here I go again. Oh, wait, modulate my voice. Okay. So my question is, when you talk about the keepers part, the area that really caught my interest was you was trying to say that the speculation will detract from a token that's intended to be used just for transactions between retail users. So are you trying to say that basically people utilizing the tokens that it was made for and creating that kind of growth is actually taking away from the value that those who are keeping the network actually receive? So you feel like those should be two separate entities or two separate ways of accounting on the chain, or what are you trying to say actually in that portion?
So I'm just trying to say that transaction on a network should just be kind of arbitrary value transfer. So like you shouldn't have, like, let's say it's a chat network. Like a lot of people are coming out with sort of these chat apps where you can also transfer value. You shouldn't be forced to just transact in the native token. You should be able to transact whatever coin it is, because if you believe in Hayek economics, then you should probably believe that just the most stable currency should be the currency that you use for transaction of value between users. And then whoever sort of secures the network or provides some critical utility layer like validation or something like that, they're probably more interested and more relevant for the native token. And for most transactions across retail users, we should just use stablecoins. Now, I may be biased because I'm pretty into stablecoins, but I think that'll be the way we go.
Yeah, that definitely explains your perspective better. Okay, makes sense. Where do I throw this to?
Any other question?
Ooh, I don't want to hit nobody.
Can you give us some insight as to Polychain's sort of due diligence process, maybe just at a high level, how you guys evaluate projects? Obviously, the keeper thing is cool, but other than that, like, how are you guys looking at new opportunities, and
Sure.
How can I copy that?
So just a couple things. A couple things quickly on that, and specifically to how you can copy it. So we are very technically focused. So we get behind technical teams that present very compelling innovations, usually deep down the decentralized stack. So kind of protocol infrastructure layer is where we play. We're not that interested in a lot of applications and things like that. And then we're really focused when a team has a fantastically talented technical group, and then we can add value in one of 5 verticals that we can just help out a lot with because of the nature of our deep domain knowledge. So legal setup, PR marketing, smart contracts, security audits, the crypto economic design, and then hiring. And if you want to play in this market, in my opinion, as an institutional investor, then you have to be prepared to really add a lot of value beyond just money. Money is not the scarce resource, so you should be focused on providing what is scarce, and that is deep domain knowledge that's relevant for projects that can actually help. And so as a result, I just do work for projects. About half of my time is dedicated to just getting things done for projects, and that's sort of the model to replicate in my opinion. So thanks very much.
Ryan.
Thanks.